Hi, my name's Ollie and welcome back to my channel. In today's video, I'm going to explain the difference between a mutual fund, an index fund, and an ETF, as these terms are commonly confused. If you enjoyed this video, then I'd really appreciate an early thumbs up, as it really helps with the YouTube algorithm so that my content can reach more people. Also, please subscribe to my channel and press the bell icon so that you're notified of all of my latest content as I upload new videos every week on personal finance, investing, and how to reach financial freedom. Please note the information in this video is not intended to be investment advice, and if you do want investment advice, then you should seek a licensed professional. Also, past performance is not indicative of any future results. So I'm going to break this video into sections and you will find the timestamps below, but I recommend that you stick around for the whole thing as you may learn something along the way. So firstly, I'm going to explain what is a mutual fund, as these existed before index funds and ETFs, and the first one was created back in the 1890s. If you're in the UK, a mutual fund is also called an OIC, which is an abbreviation for an open-ended investment company, and basically they were created as a way for a group of people to pool their money together to buy a variety of securities. Mutual funds give investors access to diversified and professionally managed portfolios. The average mutual fund holds over 100 different securities, with the minimum being around 90 normally. These funds are professionally managed, or what's called actively managed, by which a team of people are actively researching and picking the stocks to buy and sell in the portfolio. And they are generally looking to outperform the market by doing so. And there is a number of benefits to buying into a mutual fund. Firstly, diversification. And because the mutual fund has purchased so many stocks, it lends itself to diversification, which reduces your risk by spreading out your investment to lots of different companies. So therefore, if one of the stocks crashes, then hopefully you should be okay, because that one stock only makes up a small portion of the mutual fund's holdings, and hopefully the other assets should still be okay. So another benefit of a mutual fund is its convenience to you. So you get to own a whole load of stocks by only making one purchase into the mutual fund. And if you were to do this yourself, then you would have to purchase, say, 100 different stocks. Then you would have to pay brokerage commissions every time you made a purchase. And before making those purchases of all those stocks, you would have also had to have done the research and decided which companies you want to invest in. So it will save you a lot of time overall. So another benefit of mutual funds is that they are professionally managed. So this goes hand in hand with the convenience factor, in that you don't have to pick the stocks yourself. There is a team of dedicated professionals who are making informed and hopefully researched decisions on which stocks they want to buy and sell. And another benefit of this is that they may have a much larger variety of stocks than is included in, say, an index tracking fund, but having a professionally managed mutual fund comes at a cost, which is one of the negatives of a mutual fund, in that you generally have to pay higher fees than what you would in, say, an index fund or a ETF. Because the fund is actively managed, the fund managers need to be paid for their work. And while the fees have gone down over the years, actively managed funds still charge anywhere between 0.5 and 3% per annum. So say, for example, if you invested £1,000 into a mutual fund, they could be taking anywhere from £5 to £30 of your investment. And then say if it was 10k you were putting in to a mutual fund, that would be £50 to £300 of your investment, and so on. And based on this, you will always want to be finding a mutual fund that outperforms what you are paying in the fees, because even if the mutual fund doesn't perform well in a year, you are still going to be paying fees on top of that. And so this is something to remember. Even if a mutual fund has historically good performance, past performance is not indicative of future results, and the fees can definitely add up over time. Which brings us nicely onto an index fund, where if you compare the fees of a mutual fund to an index fund, an index fund's fees are much, much lower, but they are lower for a reason. So let's explain what an index fund is. So sorry, we've just been joined by Whitley, who's going to help us carry on this video, aren't you, Whitley? Hey? So you can take a pew. Come on, where are you going? So back in the 1970s, there was a guy called Jack Bogle who got annoyed with how much mutual funds were charging in fees. So instead decided to create his own category of mutual funds called an index fund with much lower fees. So as the name suggests, an index fund manager buys stocks that track a stock market index. And if you don't know what an index is, indexes are basically made to quickly measure the stock market performance. And an index is based on a representative sample of the stock market. And for example, the FTSE 100 is a share index of the 100 companies with the highest market capitalization listed on the London Stock Exchange. And another one you will have probably heard of is the S&P 500, which is a stock market index that measures the stock performance of 500 large companies listed on stock exchanges in the United States. Now, it's worth bearing in mind that the S&P 500 isn't the 500 largest, it's 500 of the largest. And the companies that create these indexes, for example, S&P is created by Standard & Poor, and they have certain characteristics that define whether a company is eligible to be part of their index. So an index fund tries its best to technically mirror the performance of the index. So if the S&P 500 went up 5% today, you should also see a 5% increase in your index fund. And for example, if a company drops out of the top 500, this will be replaced by another one, and your index fund should normally replicate this. Because the fund only needs to purchase stocks that are in the index, the fees are much lower because you don't have to pay a fund manager to decide what stocks to buy and when. Therefore, there are fewer expenses to eat up your returns, and these are passed on to the shareholders. Index funds are technically what's called passively managed, which means the fund manager follows the index and doesn't use his discretion to buy or sell stocks. And the investment strategy behind an index fund is that it's based on the belief that it is often harder to beat the market consistently. And so the idea behind this is that you're not looking at timing the market, and instead you're looking at time in the market rather than trying to outperform the market. And there is a big debate on this, which I'm not going to go into in this video. But for example, index funds will always make money when the markets are going up. But on the flip side of this, if the market is going down, then an active manager could try to prevent against losses by moving the money of the fund into different assets. So both mutual funds and index funds have a place. So as a quick overview again, an index fund tracks an index and is not managed by a team of professionals, so is passively managed, whereas a mutual fund is ran by a team of professionals and is actively managed. And all index funds are a type of mutual fund, but not all mutual funds are an index fund. And if you are looking to get involved with an index fund, then index funds will clearly state if they are tracking an index, and if so, which one. So normally they'll say in the name of the fund, and they'll say it quite clearly, like S&P 500 or something like that. But if not, it should say in the description or in the fund prospectus, all of which you should be able to find online or from the people who own the fund. So lastly, we'll explain what is an ETF, or also what is called an exchange traded fund. So exchange traded funds are kind of halfway between a fund and a stock, and as it states, they are traded on a stock exchange. And they are very similar to an index fund, but they have one main difference. So an index fund, you can only buy and sell shares once a day, but with an ETF, you can buy and sell into the ETF whenever the stock market is open. But therefore, if you were planning to day trade one of these, then you would have to do it with an ETF, as there is literally no point in doing it with an index fund, as the price will be the same throughout the day. But one thing to bear in mind is that because you're trading on an exchange, is that you will be paying broker fees for the trades and positions that you are opening. And while mutual funds don't always charge brokerage commissions, you may still pay transaction fees for these. So ETFs generally follow a theme, whether it be that they track an index or maybe they invest in a certain area of the market, like green energy companies, for example. But ETFs give you more of a variety than an index, because the ETF could be filled with stocks, commodities, bonds, and a wide variety of other assets that you may want to invest in, but you wouldn't always get with an index. Now, it's worth bearing in mind that ETFs are generally passively managed, but they aren't always. In recent years, there has been a lot more ETFs that are actively managed. For example, If you look at ARK Invest's ETFs, they have a few which are actively managed. For example, the ARK Genomics, which I invest in, is an actively managed ETF. But if you look at their site, they should be clearly labeled. And like with everything in investments, you need to always do your own research and make sure that you read the prospectus and read all the documentation thoroughly before getting involved with something like this. So sometimes the terminology for ETFs and index funds is used interchangeably, but they're not the same. And as mentioned earlier, the difference is whether you need the flexibility to trade all day long or just once a day. So ETFs provide real-time pricing, so you can see the price changing throughout the day, whereas a mutual fund isn't priced until the trading day is over. But one of the benefits of an index fund is that they allow you to set up monthly deposits from your bank account. And one of the negatives of an ETF is that they are traded like a stock. So for example, if you wanted to purchase $1,000 of an ETF, you will have to pay brokerage commissions for that. And therefore they favor doing a lump sum investment rather than depositing each month. ETFs generally have a lower minimum investment, and the ETF's minimum is the price of a single share, which could be as little as $50 depending on the ETF, whereas a mutual fund may require a minimum of $1,000 or $3,000. But these have been dropping over time. One thing to bear in mind is if you're in Europe, you may actually be blocked from investing in US domiciled ETFs that don't comply with EU regulations. But that's not to say that you can't get a European version of that ETF which holds the same stocks. So you just need to look around. And it's worth doing your research on this because the way they pay dividends varies, and also sometimes the way they tax them varies depending on where you're based. If you're looking for some information on ETFs, there is a good site that I recommend you check out, which is called ETFDB. And you can see some of the highest performing ETFs over the past year. But like I said, it's important for you to do further research on this. And whichever product you're looking at investing in, it's important to understand whether it will fit into your investment strategy. And so I highly recommend looking at the documentation for the products that you're thinking of investing in, and also to understand the risks involved with each of these before doing so, because obviously your capital is at risk and you could end up with less money than what you came along with at the start. If you're starting out and looking for an easy way to get exposure to the stock market with the ability to do monthly deposits and are planning to hold for a long time, then I personally would pick an index fund, as these are a great choice if you're looking for a hands-off approach with low fees and also with great diversification. If you're looking for index funds, some of the biggest companies or names that you may have heard of are, for example, Vanguard and iShares, and so I'll put a link to all of their websites below this video. If you want exposure to something more specific, then I would personally use an ETF. And I am personally a fan of ARK's ETFs, with a number of them returning over 100% gains in the past year. But that's not to say they will replicate that again this year. And if you use eToro, then a number of the ARK ETFs are available on there for you to invest in. And another ETF, which I kind of wish I bought into earlier last year, and I'm still eyeing up at the moment, is one called INRG, which is a renewable energy ETF that has done very well over the past year. So I hope you found this video helpful. If you've got any questions, then please let us know in the comments. Also, please let us know, do you hold any mutual funds, index funds, or ETFs? If so, which ones are you holding and what are your opinions on them? Please let us know in the comments. I love to know what you think and I read all of your comments. If you like this video, then please give us a thumbs up, as it really helps support this channel. Also, for those of you who are interested in signing up to eToro and haven't already signed up, then there is an affiliate link in the description where if you do sign up, I will get a kickback, which helps support this channel and it doesn't cost you anything extra. And they will also give you a free virtual account to play around with to learn how the system works before doing so. And if you want to learn more about eToro and personal finance and investing, then I've got numerous videos on my channel, so I recommend you go check them out, and please subscribe and press the bell icon so that you don't miss any future updates, as I upload videos every week. It's been Ollie from Get Geek Finance. Thank you for watching, and I'll catch you in the next one.